So something's been building for a while now. And I think most people can feel it, even if they can't quite put their finger on what it is. There's this sense that the world is shifting underneath our feet. And today I want to walk you through what I believe is the final stage of a massive transition, geopolitically, financially, and socially. And when I say final stage, I don't mean things are about to get better. I mean we are approaching the point where all of these pressures converge at once. Let's start with what's happening in the Middle East, because honestly, everything else kind of flows from there. There's been a lot of talk, and I mean a lot, about whether Iran and America are going to reach some kind of deal. You know, a memorandum of understanding, an MOU. And I know that sounds impressive, but I want to be really clear about what that actually means. An MOU is not a treaty. It's not legally binding. It's basically two parties saying, hey, we kind of agree on the general direction here. That's it. It's not peace. It's not a ceasefire. It's a handshake on paper. And here's the thing. If you actually read what Iran's supreme leader has been putting out publicly, and I'm talking about stuff he published on his own website just in the last couple of weeks, he is not signaling surrender. He's signaling the opposite. He's basically saying Iran is not going back to the way things were before, not on the Strait of Hormuz, not on their relationship with groups like Hezbollah, not on their military posture in the region. He is saying very clearly, for anyone who bothers to read it, that the war and Iran's resistance through it has actually given Iran a strategic advantage, and they intend to use it. And then you've got the IRGC, that's the Islamic Revolutionary Guard Corps, basically Iran's elite military. And they've been making statements that Iran now effectively controls the Strait of Hormuz all the way around through the Oman Sea into the Red Sea. And the Houthis operating out of Yemen have announced they are not letting any Israeli vessels through the Red Sea. Any. And that includes allies of Israel. So you've got Iran tightening its grip on the Strait of Hormuz and the Houthis locking down the Red Sea. That's not a group of people who are about to sign a peace deal and walk away. Now, I know what you might be thinking, okay, but surely there are people inside Iran who want a deal, right? And yes, actually that's true. There does seem to be a real division inside the Iranian power structure. The president, who came into office more recently, has been noticeably more open to engagement with the West. A lot of the negotiations that have been happening seem to be driven by that wing of Iranian politics. The foreign minister is a bit harder to read. He seems to have one foot in each camp, which is making everything more complicated and unpredictable. And then you have the supreme leader and the IRGC, who are very clearly on the other side of this debate. There's also this really interesting wrinkle involving Pakistan. Apparently Iran, specifically the IRGC and the supreme leader, they don't trust what Pakistan is doing in all of this. They think Pakistan is trying to maneuver itself into a stronger regional position, using these negotiations as leverage. So you've got internal divisions inside Iran, external suspicion of Pakistan, and a supreme leader who's publicly saying they're not going back to the old order. Put all of that together, and I think the probability of a real deal happening anytime soon is maybe 50-50, and that's being generous. What I actually think is more likely is that Iran delays. They string things along. They let America have its big celebration. July 4th is the 250th anniversary of the country, which is a massive deal politically for the current administration. And then sometime after that, Iran officially says no. No deal. And when that happens, what we probably see is not some full-scale continuous military bombardment. What we see is something more sporadic, targeted strikes, retaliations, back and forth. Not all-out war in the traditional sense, but not peace either. And while all of this is going on, something really significant is happening in the background that most people aren't paying enough attention to. The Gulf states, Saudi Arabia, the UAE, Qatar, they are quietly renegotiating their entire future. And the countries orchestrating those conversations are Russia and China. What's being discussed, from what we can piece together, is a completely new regional architecture. One where Iran and Saudi Arabia are jointly the dominant powers, where the other Gulf states essentially fall in line with that new order, and where America's military presence in the region dramatically shrinks. Now, this might sound like geopolitical theory, but there are real concrete signs this is already happening. The UAE, which has been one of Israel's closest friends in the Arab world and a strong American ally, appears to be changing its position. There are reports of a frozen credit line with Israel. There's been a senior delegation from Abu Dhabi visiting Tehran, and there are credible reports of a payment in dollars being made from the UAE to Iran. Whether that's part of unfreezing previously frozen Iranian assets or something else entirely, it looks a lot like the UAE quietly buying insurance. As in, we don't want to be bombed if this gets worse. Let us pay our way out. And then there's this. Both Saudi Arabia and Qatar are reportedly giving the United States 6 months' notice to close their military bases. 6 months. That's not a distant future thing. That's now. That is happening in real time. So what does America do? Well, here's where it gets interesting. There are proposals actually moving through Congress right now that would essentially deepen the formal military integration between the US and Israel, merge the two defense structures more closely together, and America is also reportedly building one of the largest embassies it's ever built anywhere in the world, in Israel. So the picture that's emerging is America gets pushed out of the broader Middle East, but it anchors itself in Israel. Israel becomes the base. All the military infrastructure that was scattered across Qatar, Bahrain, Kuwait, it consolidates around Israel. And this isn't happening in a vacuum. You've got Putin visiting Beijing. You've got Iran's foreign minister visiting Beijing. Pakistan's prime minister visiting Beijing, all within a very short window of time. And the common thread in all of those conversations, I believe, is the transition to a multipolar world. The message from Beijing being, the time has come, stop waiting, the old order is ending, build the new one. Now, why does any of this matter to your wallet? Why does this matter to everyday people who aren't particularly interested in geopolitics? Well, let me explain. The Strait of Hormuz is one of the most important choke points on the planet. About 20% of global oil supply passes through it. And the Red Sea, through which a massive percentage of global shipping passes on its way between Asia and Europe, is the other one. If Iran controls Hormuz, and the Houthis control the Red Sea, that means the world's two most critical shipping corridors are under the influence of parties who are explicitly hostile to American and Israeli interests. What does that mean in practice? It means oil prices go up. Probably a lot. We're talking, in some scenarios, potentially above $150 a barrel. And that is not a number that gets absorbed quietly by the economy. That is the kind of number that shows up in your gas prices, in your food prices, in the cost of basically everything that gets shipped, which is everything. Oil isn't just fuel, it's fertilizer, it's plastics, it's the stuff that keeps the entire modern economy running. When oil spikes, everything eventually follows. Now let's zoom out and look at what this means for financial markets. because this is where things get really uncomfortable for a lot of people who are holding assets right now. If you look at American equity markets, the S&P 500 in particular, valuations are stretched. That's putting it politely. They are expensive by almost any historical measure. And the view I want to share with you is that we are either already starting a significant correction, somewhere in the range of 6 to 8%, or we will start one later this summer, probably August, and it runs through September. That kind of move down would be painful, but it wouldn't be the big one, because after that, there's actually likely to be a pretty significant relief rally. Markets bounce back, maybe S&P gets up to around 8,500. People breathe a sigh of relief, talk about how resilient the economy is. And this isn't just going to be an American recession. This is going to be most of the world. And it's not going to be a short, sharp shock that recovers in a quarter or two. We're talking about a recession that potentially lasts through most of 2028. That's a long time, long enough to genuinely hurt people, long enough to change political landscapes, long enough to fundamentally reshape how people think about their finances. During that recessionary period, what happens to interest rates? This is where it gets a little nuanced. 10-year Treasury yields, and if you're not familiar with that term, it's basically the interest rate the US government pays to borrow money over 10 years. And it's a benchmark for a lot of other things like mortgage rates. Those yields probably peak somewhere around 4.5 to 5% by the end of this year. And then, as the recession kicks in and the Federal Reserve starts cutting rates and injecting money into the system, doing what they did during COVID, what they've basically done during every financial crisis of the last 25 years, yields come down sharply. We could see 10-year yields at around 3% or even a bit below. And that's actually exactly what the government wants, because there is a mountain of debt that needs to be refinanced. When rates are lower, you can roll that debt over at cheaper terms. So in a dark sort of way, the recession is actually convenient for the government's debt management problem. Now, what does this all mean for commodities? Let's talk about copper, because copper is often used as a proxy for global economic health. When the economy is growing, demand for copper, which goes into everything from wiring to electric vehicles to construction, goes up. And when the economy slows, copper prices fall. The view here is that copper prices have either already peaked or are very close to peaking. And we could see copper fall to under $7,000 a ton by the end of next year. That's a meaningful drop from where we've been. Gold is a slightly different story. Gold has been experiencing something interesting recently. There's been some forced selling coming out of China in particular. The People's Bank of China has been draining liquidity from the system for several months, and that's pushing some gold holders to sell. So gold might have a softer patch through the middle of next year. But, and this is important, gold doesn't stay down. Let's talk about the longer view. When you look out to the end of this decade, 2030, 2031, 2032, what many analysts who study long economic cycles are seeing is a kind of final blow-off, a last massive upward move in asset prices driven by inflation. People pouring money into equities, commodities, real assets, anything that holds value as the dollar weakens and inflation runs hot. The comparison being made, and it's a sobering one, is to the period between 1978 and 1982. A lot of younger people don't have a personal memory of that era, but it was characterized by extremely high inflation, interest rates that were punishingly high, economic pain, and then ultimately a very dramatic reset. The view is that we're heading for something similar in character, if not necessarily identical in detail, as we move toward 2030 to 2032. In that scenario, gold doesn't just recover, it goes significantly higher. A floor price of around $10,000 an ounce by around 2030 is being put forward as a conservative minimum estimate, not a wild speculation, a minimum. And copper, in nominal dollar terms, could be at $28,000 a ton. But here's the catch. Here's the thing you have to understand. Those nominal numbers sound enormous. But if the dollar has weakened dramatically, and the view is that the dollar index could halve in value over this period, then in real purchasing power terms, you haven't necessarily made a huge gain. You've just kept pace with the devaluation. And that's actually the deeper point here. The dollar, as the world's reserve currency, is under structural pressure. The move toward a multipolar world, with China, Russia, and increasingly the Gulf states building alternative financial infrastructure, is slowly but surely eroding the dollar's dominance. The petrodollar system, which has been one of the pillars of American global power for 50 years, depended on oil being priced and settled in dollars. If the major oil producers in the Middle East are now aligning with Russia and China, and those countries are building gold-backed alternative currencies, that system doesn't necessarily survive in its current form. There's already real movement happening here. The Shanghai Gold Exchange is reportedly opening gold vaults in Hong Kong and in Saudi Arabia. That's not coincidental. That's infrastructure for a new financial system. Russia and China are moving toward making their currencies at least partially gold-backed. The BRICS nations, Brazil, Russia, India, China, South Africa, and all the newer members, are actively discussing a new trade currency that may incorporate gold in some form. What does America do in response to all of this? Honestly, that's an open question. There's no obvious answer. America has massive gold reserves, technically, but the gold market has been dominated for decades by paper contracts, promises to deliver gold, not actual physical gold. If the world shifts toward demanding physical gold as the basis for trade and reserves, that's a very different system than what we've had. Now, let's pivot to something that I think doesn't get enough attention in these kinds of financial conversations, and that's food. Because food security is going to be one of the defining issues of the next several years, and most people in developed countries have absolutely no mental model for what genuine food stress looks like. Part of what's driving this is the war itself. The disruption to fertilizer supply chains, and Russia and Ukraine are two of the biggest producers of fertilizers and their key ingredients in the world, means that agricultural productivity is already being constrained. When you can't get fertilizer, or when it becomes prohibitively expensive, crop yields fall. It's as simple as that. But on top of that, and this is the part that really should wake people up, there are weather patterns that are deeply concerning. We are in what looks like the beginning of a super El Niño cycle. El Niño affects global weather patterns in significant ways, causing droughts in some places, floods in others. This particular cycle is expected to crest toward the end of this year. And layered on top of that is something called the Gleisberg cycle, roughly a 99-year solar cycle that affects climate patterns on Earth. The last time this cycle peaked in a way similar to what's expected in the next year or two, it contributed to the conditions that created the American Dust Bowl of the 1930s, the decade of Dust Bowl conditions that devastated agriculture across the US Midwest. Now, I'm not saying we're definitely going to see a repeat of the 1930s Dust Bowl, but when you look at the combination of factors, solar cycles, El Nino, disrupted fertilizer supply, geopolitical instability. The risk to global food production is not trivial, and if American grain production takes a serious hit, that doesn't just affect Americans. America is one of the largest exporters of grain in the world. A significant reduction in American agricultural output has global consequences. The practical advice here is not particularly sophisticated, but it's worth saying plainly, keep your freezer full. If you have any outdoor space, a garden, even a small one, think about growing some of your own food. This isn't about being a survivalist or some kind of apocalyptic prepper. This is just about having some margin in your life against the possibility that supply chains get disrupted or that food prices spike in ways that are genuinely painful. And speaking of painful, let's talk about what all of this does to society, because geopolitics and finance don't exist in a vacuum. They shape how people live, how they relate to each other, and how they vote. When economic conditions deteriorate, when unemployment rises, when food is expensive, when people feel like the game is rigged, social stability erodes. We're already seeing this in various forms around the world. The rise of political movements, on both the left and the right, that challenge the existing order. Wealth inequality has been getting worse for decades, and that tension doesn't disappear during a recession. It gets worse. When stock markets are high and the economy appears to be humming along, people tolerate inequality more easily. But when stocks are falling, jobs are disappearing, food is expensive, and the wealthy seem insulated from all of it, that's when the politics get genuinely volatile. You're hearing talk in countries like the UK about wealth taxes, about taxing the rich more. And I'm not going to tell you whether that's a good or bad policy. That's a separate conversation. But I will tell you that the political pressure for redistribution tends to intensify dramatically during periods of economic stress, combined with high visible inequality. And if we're heading into a period where asset prices go up a lot in nominal terms, the blow-off scenario where stocks and commodities surge, but ordinary people are struggling with the cost of food and energy, you have a very volatile social mix. Think about what that combination looks like. A stock market that's nominally at 10,000 on the S&P, gold at $10,000 an ounce, copper at $28,000 a ton. All of that sounds like prosperity, right? But if you convert those numbers back into real purchasing power, adjusted for what the dollar actually buys, you're not actually much richer than you were. You've just kept pace with inflation at best. And for people who don't own significant assets, who rent rather than own, who don't have big investment portfolios, they're not even keeping pace. They're falling behind. That combination, nominal wealth at the top, real suffering at the bottom, economic stress in the middle, is historically associated with serious social unrest. Not just protests, not just political arguments on social media, real serious social disruption, the kind that can lead to civil disorder, political upheaval, and in extreme cases something even more severe. The cycles converge around 2030 to 2032 in a way that makes that period look genuinely turbulent. Now let me bring in one more piece of this puzzle, AI, because you can't talk about the economy and finance in 2026 without addressing the AI question. There's been enormous excitement about artificial intelligence and what it means for productivity, for economic growth, for investment opportunities. And a lot of that excitement has translated into huge capital flows into tech stocks, into semiconductor companies, into the companies building the infrastructure for AI. But there are some important realities that are starting to emerge. One is that the build out of AI data centers is not moving as fast as the announcement suggested. Of the data centers that have been announced, it looks like maybe 40% will actually be operational by the end of this year. Similar story for 2027. The gap between announced investment and actual deployed infrastructure is significant. And then there's the copper question. People assumed, reasonably, given how copper intensive most industrial infrastructure is, that AI data centers would be a massive new source of copper demand. And that may be true to some extent, but technology moves fast. The intensity of copper use in data centers is actually declining. Fiber optics are increasingly replacing copper for data transmission, not just for the cables coming into the facility, but within the racks themselves. Higher voltage systems are being adopted that require less copper overall. And then there's what NVIDIA, which is kind of the center of the AI universe right now, has announced. They've reportedly said that by 2028, they plan to move to photonic technology, which uses light instead of electrical signals and which doesn't require copper in the same way. They've acquired companies working on this. It's not a distant fantasy. It's their stated strategic direction. So the assumption that AI automatically means massive copper demand for the foreseeable future is more complicated than it looks. Technology has a long history of finding substitutes for the materials that are in constrained supply. It doesn't always happen quickly enough to matter, but it does happen. We are entering the final phase of a world order that has been in place since the end of World War II, and in some respects since the end of the Cold War in the early 1990s. In financial markets, we're likely in the latter stages of a cycle that will include a significant correction, a relief rally, a global recession, and then, toward the end of the decade, a final blow-off phase marked by high inflation, surging nominal asset prices, and a dramatically weakened dollar. That last phase, sometime around 2030 to 2032, is going to be turbulent in ways that go well beyond financial markets. In terms of commodities, gold is the clearest story. It's heading much higher over the coming years, especially in the second half of this decade. On food, this is not something to be complacent about. The combination of geopolitical disruption to fertilizer supply, adverse weather patterns driven by solar and oceanic cycles, and the potential for drought conditions similar to the 1930s is a genuine threat to food security in ways that we haven't faced in most living people's lifetimes. And socially, when you put all of this together, the economic stress, the wealth inequality, the political polarization, the declining faith in institutions, the trajectory towards social unrest is pretty clear. So what do you do with all of this? Well, practically speaking, the advice that comes out of this kind of analysis is fairly consistent. Gold, physical gold, has a role in protecting purchasing power through this period. Be cautious about equity exposure as we head into the back half of this year and through next year, even if there's a tempting relief rally. Think carefully about food security in a way that most of us in developed countries have never really had to do before. And maybe most importantly, understand that the world is genuinely changing, not in the superficial ways that get talked about constantly in the news cycle, but in deep structural ways that take years to fully play out, but that are accelerating right now. The multipolar world that Russia and China have been pushing for is not a distant aspiration anymore. It's being built. The dollar's dominance is not absolute anymore. Gold is coming back as a serious monetary asset. The Middle East is reorganizing. The the US is recalibrating its global role.